Ready for This Time is Different report? Let's get into why Goldman Sachs says this time is different and that the inverted yield curve isn't as bad as it seems. We know that generally the inverted yield curve, when you look at the difference between the 10-year and the 2-year treasury being inverted, is a surefire signal of a recession to come. And it is one of the most prominent signals for bears to say, we're done. We're out. We are sitting the sidelines because it's just a matter of time. The bond market knows best. Now, Goldman Sachs says, well, maybe they don't. Let's analyze why Goldman Sachs thinks that, especially since the most dangerous words in investing are this time is different. But before we do, let's give you a quick reminder of what the yield curve chart looks like. This is the chart of the inverted yield curve. As you can see, we had a massive inversion, lower than where we sit now, right before the banking crisis. We were so inverted because that February and January data was coming out so strong. Markets were convinced the Federal Reserve was going to hike us to oblivion. When the banking crisis occurred, we actually had a very rapid steepening of the yield curve because markets thought, oh my gosh, this is it. The Fed will stop hiking because of the banking crisis, and they won't drive us into a deep, dark, ugly recession. Now, the bond market once again seems convinced with an almost 100 basis point inversion of the yield curve. This type of inversion, by the way, forecasts over 500 basis points of Fed cuts being priced into the market going forward. Now, there is a potentially simple explanation, and we'll look at what Goldman says. A potentially simple explanation is, look, everybody expects inflation to be transitory now. And if you expect inflation to be transitory, you expect that the 10-year treasury yield and the 2-year treasury yield won't last this long. So what happens? People demand a higher yield now for 2-year bonds because we're still in a period of high inflation. But when that high inflation goes away, people will once again return to accepting a lower yield on the 2-year and a higher yield on the longer-term commitment, the 10-year. Who knows? That's been my simple explanation, though I give a lot of credence to the bond market and I like to pay attention to anything that's potentially a negative signal. I'm not a big fan of getting trapped in confirmation bias. I want to see what is everyone else thinking. But lately, all the bears have been flip-flop. Okay, well, not all of them, but I vomit when I see the bears flip-flop with the argument of, well, we're still bearish, but we're going to increase our equity allocation because, stocks are going up. That was T.S. Lombard for you. Lost a little respect there. Anyway, Goldman Sachs. First, I think note 4 is their inverted yield curve discussion, but let's take a look at some of the things that Goldman Sachs is saying here. First, Goldman Sachs just cut their probability of a U.S. recession, starting within the next 12 months, to just 20%. 20%, that is down from 25%. It is also down from the 35% chance of a recession within the next 12 months that they argued for back during the banking crisis. And it is way below the 54% amongst Wall Street Journal economists who are surveyed on the probability of a recession within the next 12 months. Now, what do we have on the second argument here? Argument number 2, U.S. economic activity remains resilient. Q2 GDP growth tracking at 2.3%, consumer sentiment rebounding sharply from depressed levels, unemployment falling back to 3.56% in June, initial jobless claims reversing most of their mini spike in jobless claims. True, those have been pretty stable. We do expect some deceleration in the next quarters when it comes to employment because of the slower real disposable income potentially leading to some lower sales. Interesting, especially since we did just get retail sales numbers. Prior report, May report revised up a little. June report revised down a little bit. But easing financial conditions, think about that. A rebound in the housing market, easing financial conditions would be lower yields, we have been seeing that. Rebound in housing, I have been seeing that. And the ongoing boom in factory building all suggest the U.S. will continue to grow, albeit at a lower trend pace. Okay, it's a good setup so far. Then they argue that even though we have this student loan headwind ahead of us, which is now widely being associated with basically a 5% cut in people's income, Goldman Sachs believes the biggest growth drags are really behind us. I've personally been arguing that we really lack a lot of negative catalysts ahead of us. Short of some kind of black swan, it's very difficult to see big negative catalysts right now unless we have some really bad earnings season. But so far, that doesn't seem to be the case. The 0.16% increase in CPI ex food and energy in June was the lowest since Feb of 2021, follows a string of 0.4 readings. But it doesn't mean it's just 1 month of better news, as measures of underlying inflation, such as trimmed mean CPI and PCI, or PCE rather. Here I am thinking about PCI cards for computers, because I'm installing one. But anyway, PCE has been easing for quite a while. Moreover, there are strong fundamental reasons to expect ongoing disinflation. Used car prices are sliding on the back of higher auto production and inventories. Rent inflation still has a long way to fall before it catches up to the message from median asking rents. So that's owner's equivalent rents, which is what CPI uses. It's like a 34% weight. And market reads of rents. Big disparity still, suggesting you still have a lot of tailwind to get this inflation down, which is great. And the labor market continues to rebalance with a slow downtrend in job openings, but then also fewer quits, which is good, and nominal wage growth. That's still positive for workers because you're still making money. Real wage growth just went positive, but it is you're not growing your wages as quickly as you once were. Now, what about the yield curve? Because this is the part that I think is so fascinating, where you have Goldman Sachs finally, and it's been a while. I mean, I've been trying to explain why it's possible that the yield curve could be inverted and not signal a recession for, I feel like, a year now. Anyway, Goldman Sachs, here we go. We don't share the widespread concern about yield curve inversion. Conceptually, an inverted yield curve means that the rates market is pricing in future cuts that are large enough to outweigh term premium, which accounts for its usual upward slope. In English, when the yield curve is inverted, markets expect the Federal Reserve to cut rates so quickly and in such a large way that you have higher yields now that are greater than the usual reward you get for committing your money longer. Usually you commit your money longer, you make more money. And when you get an inversion, it's because the markets, for some reason, are expecting big cuts. Now, there are two reasons the markets can expect big cuts. One, recession panic, and then you get, cuts and a steepening yield curve, and that tends to be the really painful part. It's not the inversion, it's usually the steepening that's the painful part, usually. And then, of course, you have, this potential for disinflation. To be why we're seeing this. But okay, let's keep going with what Goldman's argument is. Okay, so reading this properly, in the past, in other words, the inverted yield curve, right? Are you ready for this? This has generally only happened in situations where a recession was becoming clearly visible. Okay, now this is important because they're arguing that usually you saw a yield curve inversion once it was blatantly obvious that you were going into a recession. Now that's interesting. We'll look at some charts in a moment here. But that's very, very interesting. Hence, the curve's strong track record as a recession predictor. In other words, they're kind of throwing cold water on this indicator saying, look, it's so good because by the time a recession is usually obvious, that's when the yield curve tends to be inverted. When it's already obvious. That a little bit feels like cheating, honestly. But, okay, let's keep going here. So, but 3 things are different about the current cycle. Oof, boy, we love those words. This time is different. Not really. But okay, keep going here. 3 things are different. Let's hear what the 3 things are. First, the term premium is well below its long-term average. Okay. In other words, the amount of money that you get compensated today for investing your money into treasury bonds longer is already relatively low. So you don't get that much of a premium anymore these days, just for investing your money longer term. Before COVID, the premium you'd get between the 10 and the 2 year, like if you looked at 2018, was somewhere around 30 to 50 basis points. Relatively low. That was your positive term premium. Okay? Second, there is a plausible path to Fed easing on the back of lower inflation. Now, of course, some bears argue this is going to lead to a disaster of basically the Fed creating, stimulating again, and then what? You end up with an oopsie doopsies inflation again. Now, remember though, we already know, because we've studied this so much on this channel, that what caused inflation during COVID was not the fact that we printed money. It was how rapidly we printed the money. So yes, we could return to what we saw between 2010 and 2020, which is where we slowly printed money and didn't have any inflation. Kind of wild. All right. In fact, both our and the next FOMC's non-recession projections call for more than 200 bips of gradual cuts over the next 2 to 3 years. That's 2 to 3% of cuts over the next 2 to 3 years. Third, okay, so two reasons so far. We started out with a low term premium. We're already pricing in Fed rate cuts without a recession. So, usually you get an inverted yield curve when you're pricing in rate cuts because of a recession. But we're not seeing a recession yet. So the inverted yield curve happened so early. And maybe that's a sign that, the markets are just reacting to the fact that the Fed's expecting to cut. Okay? Third reason. If forecasters are overly pessimistic now, rate market investors, and thus expectations priced into the yield curve, are probably also overly pessimistic. So the argument that the inverted yield curve validates the consensus forecast of a recession is circular. In other words, the more people say the inverted yield curve is going to cause a recession, the more people in the bond market start pricing in a recession. And then the more economists start pricing in, oh my gosh, we're probably going to have a recession in the next 12 months. And then you get this sort of reiteration. Now the yield curve inverts even more, blah, 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 right? Now there are two more pieces here from Goldman Sachs, but Matt Thompson here says, declining earnings in commercial real estate are big negative catalysts. The problem with this is, as we just saw from the Wall Street Journal, S&P earnings are already expected to fall 8.1% per share. EPS down 8.1% per share year over year. You're in the earnings recession. Yet what's the stock market doing? It's going up. Why? Why is it going up? Because people didn't believe inflation would be transitory. Now that it's turning out to be somewhat transitory, people are slowly getting back in the market. In fact, a lot of us, I guarantee it, and some of you watching this feel this way right now, a lot of us are like, please just give me one more dip. I've been missing out. Let me put more into the market. This is normal. It's totally normal. And when we look back at 2020, everybody was like, please let there be a double dip. I just want another chance to buy, bro. And it just kept going up and up and up. I'm not saying it's healthy, how quickly it's happening, but it's remarkable that the market is going up when you're already expecting negative EPS of 8.1% and net income falling by 11.4%. Now, this other argument Matt Thompson here says is that, well, what about commercial real estate? Well, so far, commercial real estate has done jack huda nothing. Sure, there are write-downs for offices. Loan loss reserves are going up, even at banks like Morgan Stanley for these offices, and potentially this office and retail commercial crush. But I mean, we're talking about 3-4 years before we start seeing some of these refinances really roll. And at that point, is the economy already well beyond? Who knows? Now, Zero Phases here says, but the S&P 500 is overbought on the 6-month chart. Been overbought for like 3 years. It makes you wonder if it has to do with sort of how rapidly people now get in and out of the stock market. Who knows? Okay, so let's get to the next argument from Goldman here. Argument number 5. Check out me, Kevin's amazing programs on building your wealth link down below. Not only is there a free newsletter you can click on down below, but you've got these incredible courses. We do fundamental analysis on real estate. We do those in our live streams as well. We're going to be doing a lot of those together when we're doing analysis for house hack or your own deals. Property management, do-it-yourself property management, rental renovation, stocks and psychology of money. And probably the most popular bundle right now is the triple. Stocks and psych, 0 to millionaire real estate, and this, how to get more done, and how to make more money and get SH9T done faster, featuring AI. It's basically where I break down exactly for you how you can actually be productive with artificial intelligence today, rather than like trying to learn how to sit here and code or whatever and figure out how you're going to create your AI bot or whatever. Let's get you caught up to speed and get you productive with AI today. That's what this course does, along with, some of the other amazing things. So check that out, link down below. Email us at staff@meetkevin.com if you got bundle up questions. So going back to Goldman Sachs right here, a 25 basis point hike, 5.25% to 5.5% at the July meeting is almost certain, but we expect it to be the last of this cycle. Despite some assertions to the contrary from more hawkish participants, we don't think that the September meeting is truly live. Both in the June press conference and in his congressional testimony, Powell argued moving carefully. We're at a careful pace now since we're closer to our destination. The minutes also signaled they probably didn't have a majority for confirming what they're going to do at the next meeting. But what's more likely to be live, according to Goldman Sachs, is the November 1st meeting, where you're going to end up with 3 more CPI reports and 4 more PCE reports. Lots and lots of data. All right, then we've got number 6. Most of the G10 banks are still a little bit further from the Fed at completing their tightening cycles. Now, we did just get some great numbers from the Bank of Canada for inflation. Thanks, Max, for pointing those out on the month-over-month decline there at headline under 3%. The Bank of Canada is still widely expected to deliver their final rate to 5.25%. They're probably just trying to copy America. We expect the Reserve Bank of Australia to deliver one more 25 BP hike. Let's see, and another 2, in August, and then another 2 later in the year. No big implications for some changes of the guard. You've got UK is probably going to get to a terminal rate of 6%. Another 100 basis points to go, thanks to that rising core inflation rather than falling. And then Goldman Sachs does price in fewer cuts for Canada, Europe, and the US than markets are looking at for next year, which is somewhat negative, right? But that's also on the back of a stronger economy. So when we look at the inverted yield curve, chart-wise again, this is the inverted yield curve over history. And what I'd like to see is, when did we actually get this inversion here and here in the dot-com era? Let's compare that. So I'm going to get the actual dates for that. So the inversion in the yield curve happened first in, it looks like it's going to be in 07? 06. 06 was your first inversion. I don't know if you could say that we were convinced that a recession was ahead of us by 07, but okay, interesting argument. Still Goldman Sachs. Then you've got the 2000s era. We really saw the inverted yield curve as early as February of 2000. I mean, these were pretty leading inversions. So I think that the leadingness of some of these inversions actually potentially gives you a little bit of a counter argument to Goldman here, in that we had our below 0% here pretty early when you had the recessions, certainly later. The recessions almost more where the steepening sat. So I don't know if that really helps Goldman's argument much. But either way, I personally do agree with a couple of the arguments they make regarding the inverted yield curve, that you've got this doom loop of forecasters go, oh, no, definitely recession. That increases your inverted yield curve. But you also have my argument of disinflation, and then Goldman's argument of Fed rate cuts already being priced in a non-recessionary environment. So is it possible this time could be different? Who knows? Again, those are the most dangerous words in investing. So you should prepare for no. But then on the other hand, do you prepare for yes? I don't know. I don't think this is where you could just look at these data points. You have to look at everything holistically. Stronger retail sales, or at least non-negative retail sales, consumer spending, Bank of America suggesting, hey, people still have higher deposits than they did before the pandemic. Inflation trending down very rapidly. Earnings not coming in as bad as expected so far. Fingers crossed it stays like that. But we'll see. Now, I want you to know this. When it comes to AI, time is what's going to make you money. And if you can prove that value to an employer, you'll always be able to be employed. So this is another way of making sure that you don't get replaced by